This is Al Brooks, and this is my price action trading course. The current module has to do with trading swings into the close of the day. You need to know who has controlled the day. So at some point in the middle of the day, you should be looking for swing trades that could last into the close. But to take those swings, you need to know who is in control. Do the bears or the bulls have an edge? On a strong trend day, it's obvious. For example, if it's a strong bull day, you're going to look for to buy for a swing into the close. On the other hand, on a trading range day, it's not necessarily so obvious to see who's in control. You have to look for signs that might tell you that the bulls have an advantage or the bears have an advantage. If the bulls have an advantage, that increases the chances that you'll get a rally into the close. If there's more selling pressure, if there's more signs that the bears are in control, that increases the chances that you'll get a swing down into the close. You should take a look at the module on pressure. I talk about signs of buying pressure and signs of selling pressure. Without going through the list, here is some of the things that would indicate that the bulls are in control. Some important examples: more bull bars than bear bars, consecutive bull bars bigger than bear bars, bars closing near their highs, bull microchannels. Well, I guess I am going through the list. Bars with tails on their bottoms, bull breakout bars with gaps. In other words, the close of the current bar is above the high of the prior bar. The next bar has a low above the high of the prior bar, so you have a micro bar, a micro gap. After a bull bar, you get another bull bar. You get follow through. The number of consecutive bull bars is more than the number of consecutive bear bars. The bull bars are getting bigger. The bodies are getting bigger. The number of bear bars and the number of consecutive bear bars is becoming less. The bear bodies are getting smaller. All of these are signs that there's building buying pressure, that the bulls are taking control, even though the market still might be within the trading range. Selling pressure, if you see just the opposite of what I described, if you start to see more bear bars than bull bars, if you start to see a series of consecutive bear bars, if the bear bodies are bigger than the bull bodies, if the bars are closing near their lows, if you start to see bear microchannels with no pullbacks, right? Consecutive bars with no pullbacks. If you start to see tails on the tops of the bars, that means the bars were selling off into the close. If you see bear breakout bars with gaps, if the close of the current bear bar is below the low of the prior bar, there's a gap. If the next bar has a high below the low of the prior bar, then you have a micro gap. If you start to get an increasing number of consecutive bear bars, in other words, 3 or 4 bear bars, and then an hour later you get 5 consecutive bear bars. If you start to get bear bars that are bigger than what they were, if the number of consecutive bull bars decreases, so let's say you no longer get 2 or 3 or 4 bull bars in a row, now you only get 1 bull bar and then a bear bar, or 1 bull bar and a doji. If the bull bodies are getting smaller, this means the buying pressure is drying up and the selling pressure is increasing, and it increases the chances that you'll get a bear swing into the close. If there's clearly more buying pressure, look for a buy setup for a possible swing trade into the end of the day. If there's clearly more selling pressure, look for a sell setup because you might get a swing down into the close. Let's take a look at this chart. We had a sell-off during the opening range, and then we went into a trading range for the middle 4 hours of the day. Okay, is there more buying pressure or selling pressure? Probably more selling pressure here, but look for some subtle things that took place here. We have a bear bar. What kind of follow through? A doji. Another bear bar. What kind of follow through? Doji. Okay, we have a bull bar, doji, bull bar, bull bar, bull bar, bull bar. We have 4 consecutive bull bars, 6 bars without a bear body. A bear reversal bar, but then a bull bar. A bear reversal bar and a bull bar. All right. Here we got 2 consecutive bull bars, 2 more consecutive bull bars, 4 more consecutive bull bars. All right. So we're getting more consecutive bull bars. The bear bars are not having good follow through. This high is followed by a higher high and then another higher high. This low followed by a higher low, higher low, higher low. Okay, so it looks to me like the bulls are taking control over the market, even though we're still in a trading range. So will we get trend resumption into the close and another leg down, or will we get a trend reversal and another leg up? At this point, I think the bulls look stronger. Okay, this is just to illustrate what I said. We have a bear trend. We broke the trend by going sideways. We have 6 consecutive bull bars here, an 8-bar rally here, and only one bear body, and a possible higher low major trend reversal. So a bear trend, trend line break, and a higher low. Subtle, but it's still a higher low, and now the market's trying to break to the upside with this 2-bar bull spike. We've had 3 hours without 2 consecutive bear bars, right? So there's an absence of selling pressure. So the buying pressure, I think, is greater than the selling pressure, and the odds are we'll get a bull breakout. Here's a buy signal bar, so you could place an order to go long 1 tick above its high. And then you have this strong bull bar. So you could buy, you'd get filled right here on this bull bar. If you want, you could wait for the breakout and see if it looks strong and then buy the breakout. You could buy this close, or you could wait until the next bar, and if it's a bull bar, that confirms the breakout, and you can buy that close. Okay. So let's say you bought the close of the bar. You got a strong breakout. The context is good. You have a major trend reversal, higher low major trend reversal. We have a test of the moving average twice, and the bears were unable to get the bar, get a bar below the moving average, and we're turning up. You have a big bull body. On the chapter, on the module on breakouts, I talk about strength of breakouts. Here, this is a very strong breakout bar, a very big bar, closing many ticks above the high of the prior bar and above the top of the trading range. It's closing near its high, and it opened near its low. Those are all signs that this is a strong breakout, and they increase the chances that there'll be follow through that will turn into a trend. The bar after the breakout bar, it's a small bar, yes, but a bull body, and that's a sign of strength. That's a good follow through for the bulls, and it increases the chances that will go up. If there's a successful breakout, there may not be a pullback for a long time. Once everyone decides that the market is always in long, traders are going to be buying at the market. They'll be buying tiny pullbacks, 1 or 2 tick pullbacks. If you wait for a pullback so that you'll have smaller risk, you could end up missing the best part of a trend. So instead of waiting for a pullback that may not come until the trend has already gone a long, long way, buy small now at the market and put an appropriate stop below the bottom of the bull spike. You can see the module on how to trade trends, and also on how to, in this case you'd be looking at the module on how to trade strong bull breakouts, and then also on the module on how to trade channels, presuming that this comes into turns into a channel at some point. You're never going to be more than 60% certain, but when you look at that breakout, you'll say, yeah, I think that's going up. That is the definition of 60% certain, right? 60% is as good as it gets. Don't worry that you might be wrong 40% of the time. You are. You're going to lose 40% of the time. That's part of the business, right? You're a trader. 60% is as good as it gets. You have to trade. Once you think the market is always in long, buy at least a small position. You can look at the module on trading breakouts and trading strong trends. Should you wait for a pullback? No, don't wait. Buy small. So if this risk is more than you want to take, trade half size, trade quarter size. Just trade. If you wait for a pullback, it may be way up here before you get a pullback, and you'll miss a huge trend. All right, this is a problem for you if you're waiting. We have another breakout here, close above the high of the prior bar. Yes, a tail, and yes, a doji bar afterwards, but to me this is looking like a strong bull breakout, and you have to get long. Where's your stop? still down here. Maybe below here, but certainly below here. Another bull bar, right? So now we got 5 consecutive bars up. I would not wait for a pullback. I would just keep buying. Another stronger breakout. So those traders waiting for a pullback now are getting really upset. The market is racing away from them. You could still buy closes. This might turn out to be an exhaustion gap because we're getting near the high of the day, but I would still be buying closes. Another huge bull breakout bar, the biggest bar of the entire rally, but it's right at the high of the day. So high of the day, resistance. In general, I don't like to buy closes when we're right at resistance because there's too much chance of a pullback. Also, when I get the 2 best looking bull bars occurring late in a bull trend, too much chance that they'll attract sellers. Who's going to be selling? Well, the bulls. The traders who have been buying all of these closes all the way up need to take profits at some point, and these 2 bars are a gift, an exceptionally big profit, and we're right at resistance. So this will attract sellers. It'll attract the bulls who've been buying all through here. It'll attract them to sell out of their longs. This could simply be a buy vacuum test of resistance, and we could end up getting a 10 bar 2-legged correction. And that's what we did. We got one leg down here and a second leg down here. If you did buy above the signal bar, here's your initial stop. You could take half off at 2 times your risk, which would be right here, and then let your final part go until you have a reasonable signal in the opposite direction. Here we have a buy climax at the high of the day, and we have a double top, and we have several bear bars. I think it's reasonable to exit below the bottom of this trading range. Also, you're going into the end of the day, right? Only a few bars left in the day. So if you're still long, you have to look for reasons to exit. And I think selling below this double top bear flag after a strong buy climax, and with the market having bear bars closing on their lows, that's a good enough reason to exit going into the close. You don't want to give any more back. What about using your actual risk instead of your initial risk for your profit target? You could do that. These signal bars are relatively small. We're probably going to get some kind of measured move up. We'll probably at a minimum get to the top of this bear bar. So I would not want to use a target that was too small. Okay, I said you could also buy a breakout above the top of the range. You could buy the close of this bar. Let's say you bought the close of this bar. Your initial risk is below the low of the bar, right? So here's your entry price, here's the risk. You could, since at this point the probability is 60% certain that the market's going higher, you could exit half at 1 time your risk, which would be right here. Or you could say the trend is getting so strong, people are buying closes, let me try to get out at 2 times risk. So you could take half off here. Again, I would take final profits going into the close below this double top bear flag after this buy climax. Alright, here's an example of buying pressure. Breakout mode, so you're looking for either a reversal up or a resumption of a trend. Okay, so we had our initial sell-off, okay, big gap up, and then a sell-off down to the moving average. And then we're sideways, and you have to assess the buying pressure and the selling pressure. And here we have 3 consecutive bull bars, 3 more consecutive bull bars. We have 3 bear bars, not good for the bulls. We have 3 bear bars, not good for the bulls. But look at the lows and the highs. We have a low, a higher low, higher low, higher low, right? We have a high, we have a higher high, and we have a higher high. So, you know, we're starting to trend. We're in a trading range, but we're also in a bull trend. You know, we're getting higher highs and higher lows. That's the definition of a bull trend. We're also in a trading range, and you can also argue that we're still in a broad bear trend as well. This high is below that high, and this, you know, we got a low and we have a lower low. So, it's, you know, at the moment we're in a trading range. We're in a big bear trend, okay, broad channel at this point, and we're starting to get a bull trend. My concern about these consecutive bull bars is that the bears are still getting several consecutive bars in a row. Okay, we have a pullback from, we have a bull breakout, and we have a pullback with 9 consecutive bars above the moving average. That's also good for the bulls. The bears are unable to get a close below the moving average. So to me, this is pretty good buying pressure, and I think the odds are we're going to get a bull reversal going into the close. Also, higher low, major trend reversal, a bear channel, a bear trend. We have a breakout above the moving average, and it continued up here, a bigger breakout here, and a higher low. So, to me, this is, I think, a reasonable buy. So you're looking for a reason to buy. We have a bull signal bar here, above the moving average, another higher low. I think you could buy above the high of that bar. It's a channel, right? A bull channel, which is the weakest form of trend, and a bull channel might be a bear flag, and we might get bear resumption into the close, but I think the buying pressure is slightly better than the selling pressure, and I would rather look to be a buyer. But there are problems with the bull case. The one that concerned me the most, 3 consecutive bear bars, 3 consecutive bear bars. If the bulls were all that strong, we should not be getting 2 sets of 3 consecutive bear bodies. Okay, good signal bar. I think you can get long above its high, so you got long here. Okay, not a great looking entry bar, but you are long, and the stop is probably below the low of the signal bar, maybe below the low of the tight trading range. Not a good entry bar, but good follow through, and more good follow through as well. So we have 3 bars, 3 consecutive bull bars. 2 of them are particularly strong for the breakout, and we have 5 consecutive bull bodies. Okay, your initial risk is 1 tick below the signal bar, and your entry price is 1 tick above, and 2 times your initial risk is this red line. Okay, so you can take half off there. You could also use actual risk. So once the market has this bull bar, you can say, well, you actually had to risk only to 1 tick below this, actually 1 tick below your entry bar, so your actual risk is probably, 2 times your actual risk is probably here. And you could exit there as well. I think the bull spike is good enough, so you could try for 2 times your initial risk. Okay, a problem, okay? Instead of hitting your target, we're starting to pull back. I think the market's still always in long, probably from the close of this bar. Okay, the bears want this to be a failed breakout at the top of a channel. I don't have a channel line drawn in. They want it to be a failed breakout after testing the small upper range. But to me, the 2 bear bars are not as strong as the 5 bull bars. So I think this is simply a pullback from the bull breakout, and not a failed breakout leading to a bear trend. If you're not long, you could buy above this bar. If you took your scalping, if you exited half at 2 times your actual risk and got out over here, you can put that second half back on 1 tick above the high of this bar. Okay, almost to the target, so you might want to tighten your stop. You don't want to give everything back. Okay. Protective stop below the bottom of the signal bar. If it was here, I certainly would move it to below here, maybe below here, maybe to 1 tick below the high of the breakout point, 1 tick below the high of the signal bar. Okay, you could also go to break even, okay, or you could go to 2 ticks below the low of this bull spike, these 2 big bars, or below the low of the entire spike, the low of this bar. The bigger the stop that you choose to use, the more likely you'll make money. But when you do lose, you lose more. And it doesn't matter which of the choices you use. You could use a wider stop, have a bigger probability but bigger risk, a tighter stop, a lower probability, and smaller risk. Okay, so instead of getting filled on a long above this little bull bar, the market reversed sharply and broke to the downside. This should not be happening if the bulls own the the market, right? So most traders would stop out at either break even. If I had my stop down below the signal bar or below the bull spike, I would probably get out at the market with this bar. It's a second leg down and it's bigger than the first, and it's not what I want to see if I'm looking for a rally, especially when the market came so close to a target and reversed down. Okay, so if you draw a trend line below, this bar is closing below the moving average and below the trend line. A trend line is always part of a channel, so it's breaking out of the bottom of a bear channel. We had a bear trend in the open, and then we have a bull channel. A bull channel can be a bear flag, so this could be the start of a bear trend into the close. Okay, this is the top of the channel. We did not quite reach that line, but you could draw some kind of best fit line, and it's probably pretty close to it. At this point, the market's always in long after 5 bull bars. But at this point here, I would be questioning that. I would not take this as a sell signal. You can argue, if you draw a best fit channel, that it's at the top of a bull channel and the market could resume down. I think the market went always in long on this bar, maybe on this bar. So I personally would not take that short. You could say that every time we go to a new high, it's selling off, and it is. But these bull bars are strong enough, so I would not take that short. We sold off a little bit more, but still a higher low, and now we're trying to rally above. But we broke out of the bottom of the bull channel. That means we broke below the trend line. We sold off for about 10 bars. We sold off below the moving average. So you got to be thinking about the possibility that we're forming a major trend reversal. We had a bull trend for about 30 bars. We broke below the bull trend line, and now we're forming a lower high. So to me, this is a lower high major trend reversal. Yes, it's a tight trading range, but I think it's still a lower high major trend reversal, and I think a reasonable swing short. It's not high probability, it's low probability. It may only be 40%. So you need to go for at least a reward twice your risk. Maybe hope to get a move down to a new low of the day. Maybe with luck, you'll get a leg 1, leg 2 move down. So anyway, you take the short below your signal bar, so you're short right here. Your initial stop is above the high. You could go for a reward equal to twice your risk. The signal bar is very small. That would take you down about here. I don't know. At a minimum, I would go for 2 times the initial risk. I might go for more because these bars are so small, and because potentially we have targets further below. Each one of these prior higher lows is a target, and we may come all the way down below each one of them, maybe all the way down here. Okay, so lower high major trend reversal in the form of a small double top. You can argue, well, I don't want to short this. We got too many bull bars, and that's a weak signal bar, and that's okay. You can wait. Whenever you feel like you're not confident with what's happening, then just wait. Okay, we got a breakout here, a pullback, and then a bigger breakout. At this point, you have to assume the market is always in short. Always in short. If you're flat, you can sell the market and put a stop above the high of the bar. You don't know how far it's going to go. At this point, a leg 1 equals leg 2 move seems unlikely. This could turn into a large trading range. However, at this point, we had the double top lower high major trend reversal. We had a breakout here, and now we have a bigger breakout. I think the market's always in short for most traders, and stop at this point is probably above the high of this bar. So you could sell this close, put your stop up here, and go for at least a measured move down. Since the probability is high, in other words, you look at it and you say, yeah, this is going down, you assume probability is 60%. When the probability is 60%, you can take a reward equal to your risk and still have a trader's equation, a positive trader's equation. So you could sell this close, put a stop above, go for a measured move down, and take half off, maybe all off. Okay, so you can move your stop to above the top of the big bear bar. We have a bear close here, which is good. so it's confirmation of the breakout. I don't like the big tail. But then we started to get another bear close, another bear close. So to me, this is a sell to close this market, and I would just keep selling all the way down. No sign of buying. You could argue possible sell climax here, but more confirmation. Another bear bar. We're going lower. We're getting late in the day, so I probably would not be selling closes, but to me there's no sign of a bottom, and we should continue down. Another big bear bar, so you can tighten your stop to one tick above its high. So even if you waited to sell at the close of this bar at this point, you'd still have a small profit if the market went above your new protective stop. Another big bear bar. This could be a sell vacuum down to the target. Here's the leg 1. Leg 2, same number of ticks, and we're down to the reasonable target, and we have another consecutive sell climax. To me, I personally would get out. I probably would get out on the close of this bar, but if you wanted to, you could get out above its high. We have a 2-bar reversal. You could get out above the bull bar. Okay? All right, so you look for tests and failures. In the final market, in the final hour or so, the market often tests support and resistance. Support and resistance are magnets. All day long, they're magnets. And the market can sometimes get vacuumed quickly down to support, only to reverse, or vacuumed up to resistance, only to reverse. Okay? If the current price is close to a support or resistance level, then the market's within the magnetic field of that level. And like any magnet, the closer you get to the magnet, the stronger the pull becomes, and the faster the market gets there. So very often you get very big bars leading to support and resistance. The market gets vacuumed to the target. Okay, and knowing where support and resistance is, you can look for setups expecting the market to get vacuumed down to support or vacuumed up to resistance at the end of the day. Okay, look for tests of trading ranges above and below. Okay, so if there's a trading range above the market could get vacuumed up to the trading range. If there's a trading range below where we are, the market could get vacuumed down to the trading range. Trend lines and trend channel lines, those are always magnets. Prior highs and lows, those are always magnets. Untested closes of big trend bars, those are magnets. So if you have a big bull bar and the market starts to sell off, and it was a bar that was good enough for traders to buy the close, that close is a magnet. The market should come back to that close, because traders who bought that close will buy more as the market sells off, and they won't sell until the market gets back up to that close. So no sellers until the market's up to that close. That means the market will get drawn up to that close because it needs to find sellers. Measured move targets, those are always magnets. So at the end of the day, if there are magnets near where the market is, the market often gets vacuumed to those magnets. So you should look to place trades in the direction of the magnet. Open of the day, that's often a magnet. So if near the end of the day the market is fairly close to the open of the day, the market will try to get to the open of the day. The bears will want the close below the open. The bulls will want the close above the open. They want the daily chart to have either a bull body or a bear body. Usually, let's say the open of the day is right here and the market is right here getting close to it. Usually the market will try to poke through it by at least a tick or two, and then it will decide whether it should break out or reverse or just go sideways. Rarely it'll break strongly beyond it. Usually it'll get to it and then just kind of trade around it and close around it at the end of the day. It's a magnet, so the market usually stays near it. So even if it does break above it and then goes back below it, it usually will stay fairly close to it if the test is occurring near the end of the day. If the market tries to get up to that open of the day and pulls back and tries again and starts to turn down. Okay, so if it makes a couple attempts to get there, doesn't quite succeed, it usually gives up and then reverses and goes down to the low of the day. If the market's above the open of the day and it's pulling back and tries and turns up, tries again and turns up, and doesn't get there, it probably will try to close at the high of the day. So if it's near the open of the day, late in the day, it'll try to close at the open. But if it does not close at the open, if it does not get quite to the open, it'll usually reverse and go the opposite direction and try to close at the extreme of the day. So for example, if the open is below where the market is, and the market starts to fall down to it and starts to reverse up, look for a rally and a close near the high of the day. If the open is above where the market is and the market's trying to get up to it and it starts to reverse down, look for the market to sell off down to near the low of the day and close near the low of the day and turn the day into a bear bar on the daily chart. Alright, well, instead of open of the day, what about the weekly chart? Okay, there are magnets going into Friday's close. So if we're into the final hour of a Friday, it's the final hour of the week, you have to be looking at the open of this week, because the bulls will want the week to have a bull bar on the daily chart, and the bears want a bear bar on the daily chart. And so the bulls will try to get the open to close above, they'll try to get the close of the week to be above the open of the week. The bears will try to get it below the open of the week. You also have to look at the high, low, and close of last week and the high and low of 2, 3, 4 weeks ago. If the market is near any of those magnets, a lot of times it'll get pulled to the magnet in the final hour of the week. Okay, again, last day of the week, the bulls want a bull bar on the weekly chart, and they want the market to close above the open of the week. So look for signs of buying pressure, and those signs will attract more buying. And the market bulls might be able to push it above the open of the week and close it above the open. The bears want the opposite. So for example, here's the last day of the week. Today's Friday. And this red line is where the week opened. Alright? Not that far away. And we're starting to get buying pressure here, right? We have a trend, a breakout above a trend line, a higher low major trend reversal, a triangle with pretty good bull bars, and we're 10:30, 10 or 10:30. The bulls might be able to get the market to rally up to that open of the week. So to me, I would look to buy, especially given all these bull bars. You could buy on a stop at one tick above the high of this bar and place your protective stop below. Now, am I going to get out at 2 times my risk? In this case, probably not. I think there's a chance that we'll get all the way up to the open of the week. So I'm going to take a chance that we get a much bigger reward. And that's what happened. The market came close to it here, pulled back, and went above it by a tick or so, and then selling off. I don't want it to sell off because it may sell off big into the close, but it made 2 attempts to get there, and it finally got there and is turning down. I would get out below this 2-bar reversal. I achieved my goal. It's many times bigger than my risk, and to me that's a good enough trade. A high 2 buy, 2 legs down, but a small bull bar, especially compared to those 2 bear bars. I would not buy that. Okay, now we got a third push down, a small double bottom, high 2, a bull bar at the moving average. If you're buying this, the probability is maybe a little bit better than 50-50. I would try to get a reward twice my risk. My initial risk is below my signal bar. Okay, the market popped up quickly. At the end of this bar, I probably would try to get 2 times my actual risk. My actual risk was below the entry bar to my entry, which is right here, and 2 times that probably would be here. On the other hand, I could simply swing the long and get out either at break even or below this bar. A new high, small expanding triangle, high, 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 low, low. I probably, if I were still long, I would get out below that bar. So you can see how we worked up and down around the open of the week going into the close. the bears won. We had a close of the week slightly below the red line, the open of the week. And what about the last day of the month? Does the same principle apply? Absolutely. Okay, going into the close, the final hour or two of the month, so that last day of the month, whatever day of the week it is, you got to look at the open of the month. If it's close to where the market is right now, it's a magnet. The high and low of close of last month, also magnets. And also the high, the low, the close of any prior month, especially significant ones, like let's say the highest high of the past 4 years, or the highest close of the past 4 years. If we're going into the close of the month and we're close to any of those magnets, the market may get drawn up to that magnet in the final hour or two. Okay, here's an example. Last day of the month, the market is close to the highest monthly close in the past 4 years. All right, so this is a significant magnet. We haven't closed at that level in 4 years, and we're pretty close to it. So we should try to test it going into today's close, because today's close determines where the close of the bar will be on the monthly chart. Okay, so here we are. This is the monthly chart. Okay, and here we are. Okay, and today is the last day of the month, and in the final minutes of the day, final hour of the day, we're fairly close to the highest close of the past 4 years, right? Which was way back here. Okay, so we're very close to, actually, I'm sorry about that. No, it's right here. Here's the highest close in the past 4 years. This close is above this close, and we're really close to it, so we may get drawn up to it in the final minutes of the day. Here's the 5-minute chart, and this red line is that highest close from 4 years ago, and we're right at the end of the day. And here we have 4 inside bars. Inside, this bar is inside that, inside, inside. So intense indecision. We have a bull body, breakout mode. We have a bull spike and a channel down, so this could be a bull flag. And we have intense indecision at that close. The bulls want a close well above it. The bears want a close well below it. To me, this is breakout mode. You can buy above, you can sell below. I would place a buy stop 1 tick above. I might place a sell stop 1 tick below. But with this bull spike as strong as it is, I probably would only look to buy. To me, this looks like it could be a bull flag. A good follow-through bar, another bull bar, right? So it looks like the market's going to try to close well above the open. Right now we're testing the bottom of the opening of that upper range, and we're forming a reversal. Had I bought here, I would probably get out here. It's a failed breakout of a double top. It's a bear reversal bar at the top of the bear spike. We may come back down to test the open. Excuse me, to test the highest close of the past 4 years. I don't think I would short this. The channel up is too tight, but I would take profits on my longs. If you did choose to short this, okay, looking for a test back to the open of the day, okay, what's your probability? Maybe 50-50, maybe 40-50, 40 to 50%. Your stop would be above your signal bar. Okay, market's working lower, getting close to the open, getting close to the red line, the close from 4 years ago, and we tried to get there, we bounced. We tried to get there again, 2-bar reversal. I would probably exit my longs, my shorts above this bar had I shorted this. The market tried twice to get here, and it looks like it's reversing, so I would get out of my shorts. Would I get long? I probably would not. Okay, that is the end of my module on trading swings into the close.